Welcome back to Investing Talk Podcast. Today we're looking closely at Toll Brothers, a really prominent name in luxury home building. We've got a collection of information here, stock analysis, recent earnings, community announcements, even a detailed due diligence report. And our mission really is to sift through all this, pull out the key insights, and give you a clear picture of where Toll Brothers stands right now. We'll cover their business, how they've been doing, their financial health, and maybe what's coming next.
That's right. We've got quite a bit to work with, offering different angles on the company. The goal is to synthesize it all for you, hitting the important takeaways without just drowning you in data points. Let's get into it.
Okay, so first off, the basics.
Mm-hmm.
What exactly is Toll Brothers? It seems like they're not just your average home builder.
No, that's a good point. They are a U.S.-based luxury home builder operating across, well, single-family homes, larger master-planned communities, and even high-rise buildings in cities. And what's interesting, as you hinted, is their approach. It's vertically integrated,
No.
meaning they handle a lot of it themselves. Design, the actual construction, financing for buyers, even smart home tech services through their own subsidiaries.
So they control quite a bit of the process end to end.
It seems so. That kind of integration can give them more control over quality, maybe efficiency too.
And who are they building for? Is it just the ultra-rich?
Well, they say they target a pretty diverse range, from first-time buyers up to empty nesters, but the common thread is luxury. Historically, their average home selling price, it's been north of $800,000. They're a Fortune 500 company, definitely a major player in that premium end of the residential market.
Got it. Premium focus, significant scale.
Okay,
Let's look at recent performance. We have numbers for their fiscal year 2024. What jumps out?
Yeah, 2024 looked quite strong based on these figures. Revenue was $10.8 billion, and net income hit $1.57 billion.
Those are substantial numbers.
Definitely. And operationally, they delivered, 10,813 homes. That shows they can operate at a pretty significant scale and suggests demand was healthy for their kind of product during that year.
So $10.8 billion revenue, $1.57 billion net income. What does that tell us about their financial health overall?
It points to pretty sustained demand for luxury housing, at least through 2024, and strong profitability. Their balance sheet looks solid, too. Total assets listed at $13.4 billion against total equity of $7.67 billion.
Suggesting debt levels are likely manageable.
Likely moderate, yes, relative to their equity base. Key strengths seem to be that consistent revenue growth, at least historically, and operational efficiency.
But there are always risks, right? Especially in housing.
Absolutely. Potential vulnerabilities include, the obvious sensitivity to interest rate changes that impacts mortgage affordability and just the general cyclical nature of the housing market itself. Luxury can sometimes be more exposed in downturns.
Right, those macro factors are always lurking. Now let's shift to the more recent picture. We have first quarter results for fiscal 2025. How did things look there?
Okay, so Q1 of fiscal 25 showed a bit of a different trend compared to the full 24 picture. Net income came in at $177.7 million.
Which is down from the previous year.
Correct. Down from $239.6 million in Q1 of fiscal 24. Earnings per share followed suit, $1.75 versus $2.25 a year prior.
And revenues.
Home sales revenues were also down by about 5% year over year, landing at $1.84 billion.
Okay. But didn't they actually deliver more homes?
That's the interesting part, yes. The number of homes delivered actually increased by 3%, up to 1,991 units.
So more homes delivered, but lower revenue and significantly lower profit. What's going on there?
That is a fascinating divergence. The report mentions the lower EPS was partly due to impairments and some delays in property sales.
Impairments, like writing down the value of some assets.
Potentially, yes, or challenges with pricing on certain projects. It suggests that while they closed more deals, the profitability per home or the value book from those sales was lower in that quarter. We probably need more detail from their full filings to know exactly what drove those impairments and delays.
Okay, interesting dynamic. Despite that dip, though, they're still expanding. We saw some news about new communities.
That's right. They seem committed to growth. They announced a new luxury single-family community in Collegeville, Pennsylvania, just 10 homes, quite exclusive. And also, they're launching Toll Brothers at Gold Hill out in Colorado Springs, Colorado. That one will have both single-family homes and townhomes, with sales expected to start this summer.
So pipeline development continues. Good to see. In this market, how do they really stand out from the crowd? You mentioned competitors like Lennar and D.R. Horton.
The main differentiators seem to be that laser focus on the luxury segment and the vertical integration we talked about earlier, having their own mortgage arm, for instance. Competitors like Lennar or D.R. Horton, while huge, often compete more on volume and might target slightly different, maybe broader price points.
Yeah,
Toll Brothers has really carved out that premium niche.
makes sense. So looking ahead then, what could push their growth? And what are the big hurdles they might face?
On the growth side, expansion into rental communities looks like a strategic move. They have Toll Brothers apartment living joint ventures. That could diversify things.
Less direct exposure to mortgage rate swings, perhaps.
Potentially, yes. Also, depending on how work trends evolve, maybe a recovery in demand for high-rise developments could be a factor.
And the challenges.
Well, rising material costs are always a pressure point in construction. Regulatory hurdles, things like zoning restrictions, can slow down or limit development. And of course, the big one is an economic downturn hitting discretionary spending. Luxury homes are definitely discretionary.
Standard industry risks, amplified maybe for the luxury end. Now, we don't have livestock info, but based on all this, what might the general feeling be among analysts? Any guesses?
It's tough to say without current data, but you'd expect analysts to be watching interest rates very closely and just the overall economy's direction. The recent earnings miss, that dip in profit despite higher deliveries, that's likely a key focus. Balanced against that, you have the new community announcements showing continued investment. It's a mixed picture they'd be weighing.
Definitely. Okay, let's dig just a bit more into some specific financial metrics. We touched on revenue and EPS. What about things like their PE ratio or debt levels?
Right, so that Q1 FY25 EPS miss due to impairments and delays is certainly something to watch. For the price-to-earnings ratio, you really need context. How does it compare to others in the home building sector? That tells you about relative valuation.
And finding that means checking financial databases.
Exactly. Same for the debt-to-equity ratio. The most current figures would be in their latest financial reports on their investor relations site. You can also find historical free cash flow trends there.
What about return on equity?
Comparing their ROE against peers is useful, helps gauge profitability efficiency, and the price-to-book ratio, PB, gives another valuation perspective relative to their assets on the books.
And you mentioned they return value to shareholders. Dividends.
Yes, that's right. They recently boosted their quarterly cash dividend by 9%. That signals confidence or at least a commitment to shareholder returns.
Okay. And if someone wanted to know how volatile the stock is?
You'd look up its beta. Financial websites usually have it. A beta over 1 suggests it tends to move more than the overall market. Less than 1 means less volatile.
Got it. Let's zoom out again slightly, business and industry factors. What are their core competitive advantages, would you say?
The brand, definitely. Toll Brothers has a strong reputation in the luxury space. That's a big plus. And maybe some cost leadership within that luxury niche, perhaps from their scale and integration.
So strong brand, maybe some efficiencies, and their position in the market overall?
They're a major player, often seen as a leader specifically in that luxury home building segment.
And the big trends affecting the whole industry right now, both good and bad.
Well, on the positive side, there's still underlying demand for luxury housing, ongoing advancements in construction tech, and a growing interest in sustainable or green building practices. Those are potential drivers.
And the risks?
The risks include regulatory shifts, things that make building harder or more expensive, supply chain issues popping up again for materials, and just the overall economic cycles that always impact housing.
Standard stuff for the sector. Okay, nearly wrapping up here. Any quick thoughts on the leadership team or specific risks the company highlights itself?
The leadership, generally speaking, seems experienced in home building. You'd look at proxy statements or investor presentations for specifics on the CEO and key execs, their track record, tenure, etc.
Insider trading activity.
That requires checking SEC filings, Form 4 specifically. As for risks they flag themselves, SEC filings are the place to look. Typically, you'll see mentions of market fluctuations, supply chain vulnerabilities, regulatory changes, the kinds of things we've discussed.
And comparing them to Lennar or D.R. Horton on these points gives context too.
Absolutely. Peer comparison is always useful for understanding relative performance and risk positioning.
Okay, so to bring it all together for you listening, Toll Brothers looks like a very well-established company, a leader in its luxury niche with a strong history. But clearly, they're facing some of the current economic pressures, like that recent dip in earnings.
That's a good summary. That earnings dip contrasts with their continued expansion, those new communities we mentioned, and their move to increase dividends, returning cash to shareholders.
So the longer-term picture really seems to hinge on how well they navigate interest rates and if they can keep that premium brand appeal strong.
And that expansion into rentals, the apartment living side, that's definitely something to watch. It could be a significant diversifier for them down the road.
Which leaves us with a key question, really. How is demand for luxury homes going to hold up in this climate? And how well placed is Toll Brothers to adapt and maybe even capitalize on whatever comes next?
That's the core question for investors looking at this space for sure.
We definitely encourage you to dig into their investor relations materials if you want more detail, and keep an eye on their performance in the upcoming quarters. Thanks for joining us for this exploration into Toll Brothers. Please do subscribe, like the show, and leave us a comment. Let us know what other companies or topics you'd like us to unpack next time.